My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. I'll be with my friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, put it all in context. So call me at 1-800-743-CNBC or tweet me, Jim Cramer. Look, I got hacked real bad today. Found out when I got a call from someone from American Health and yada, yada, yada. I'll leave the rest out of it because it was actually a hijacked name from some real outfit. Yeah, some dummy company now has a lot of my information, way more than I thought, way more than my wife has. There's nowhere to turn. The deal's done. I was furious. Does anyone even care that my data, my life, my neurological history is stolen? And then I listened to the Apple Worldwide Developers Conference, and I realized, yes, there's one company in this whole darn world that really does care about not ripping me off. And that company is Apple. Sure, they couldn't stop a third-party health insurance hack like the one that so distressed me. No one can. But they do their best to keep your information private, including from OpenAI and its ChatGPT, which they announced with a shocking partnership today. Nobody seemed to even notice. Your IP is safe. You can't be tracked when you go for generative AI with help through Apple. Oh, thank heavens. When I spoke to CEO Tim Cook after the event this afternoon, he couldn't stress enough about how much info will stay on your phone. Privacy. Job one for these guys. If not for this conference, I'll tell you the truth, I would have been hiding under a loving blanket. I was so upset. All right, it didn't matter to the market what Apple said. Today was business as usual. Anything that makes semiconductors more powerful, anything that makes power for data centers cheaper and cleaner, well, that's what went higher. And that's why the Dow gained 0.18%, S&P advanced 0.26%, NASDAQ gained 0.35%. But it sure didn't even matter for Apple stock. That dropped nearly 2%. Or perhaps because it didn't have anything truly revolutionary except the tie-up with ChatGPT. People were yawning about that. Are you kidding me? This is Apple partnering with a company with deep ties to Microsoft. They were mortal enemies not that long ago. I mean, like yesterday. Tim told me that ChatGPT may be just the first of many services, though, that will be included in Apple's AI efforts. So therefore, I say, he didn't, but I say, don't discount Gemini from Google. Could happen. All day I heard there were no reasons to upgrade your iPhone from this conference, including before Tim even said anything. People were saying that. Were you watching the same presentation I was? For me, this Apple conference marked the beginning of generative AI for personal use, not corporate use, personal use. Anyone outside of those with the Apple 15 Pro and Pro Max will want to upgrade because, alas, everyone else will be upgrading. Good as read as any. You have enough data on your iPhone that it can make some great predictions and give you great insights about yourself. If you let Apple put it to work, it can make your life easier, help you be more creative, make it more fun. And that's what Cook kept stressing to me. This is personal AI, not enterprise, personal. As Tim sees it, what Apple added today was so new, so different, and so necessary that in the future you won't believe you ever live without it. And I agree. See, it's not just the phone. I saw a way to learn math today on the Mac that I wish I had years ago. I saw the Vision Pro 2 taking my 2D pictures and making them 3D. See, I want to go back in time to Gino's Steaks in Philly with Pop in 2012, have a couple of whiz-wits together with him, just like it looked when it actually happened so many years ago, when he was still alive. Tim reminded me that Vision Pro can do that for us. Of course, things do get glossed over in a quick presentation like you got today, but you got to focus. See, for me, on a day where I was frantically trying to contain the damage of some horrendous hack, where the criminal enterprise sounded so darn convincing that I did want to give them more information, I was trying to figure out who the heck is in my corner. And the answer, as far as I can tell, is Tim Cook. He's in my corner before I go into the ring with everyone else, including those who seem to only want my data for profit, which is kind of like everybody. The new phone also lets you lock individual apps so the hackers can't get to your data when they steal your phone if it's unlocked. And that's why I found the developers conference so, how about soothing? Apple Intelligence, its version of generative AI, is about using your own personal information to make everything from fixing your handwriting, which I certainly need, to interrogating your email inbox, to putting things through your own personal context without even knowing it's your own personal context, because the machine knows you better than yourself, but doesn't sell it to anybody else. Plus, you know what? It's whimsical. I mean, lots of cool new stuff. How about Genmoji? I can do what I always want. I want to create my own emoji. I'm so tired of sending the emoji with the sunglasses to one of my daughters. The emoji with the 3 hearts around it. Let's be a little more creative here. I need quick response. It's got that. I just type a description, animation, sketch, illustration. They understand me, my personal context. Or as Tim said to me, a layer of intelligence that's just not on the market today. Of course, I'm shortchanging the whole darn thing. There's a ridiculous amount of newness involved in basically exploring your digital self. Searching photos in natural language. I want to see Jimmy with Eagle stickers on his face or Lisa in a red wedding dress. Whatever. Just type in a description. It'll pick your best photos, too, with storylines. If you find what it knows is you, and it'll appear ahead of when you think of it. It really will. I'm not saying it's a mind reader, but it's pretty close to that. Or to put it another way, you can make stories, your own stories. Like they do when you start the day, you can do what you want. It's so cool to be creative. You could ask it to design what you'd like. You have a slide deck and you want to figure out what to put on it. Oh, just go ask ChatGPT. But remember, they can't track your IP. Apple's doing AI for the rest of us, not for the enterprise, but for me, for you. No, they won't be able to offer you an app that figures out when to call on customers or how to onboard new employees seamlessly or rate people's prospects or redo contracts or have the best sec DevOps or certify an application for a mortgage 32 times a day or do something internally about projections involving your own balance sheet or have the dashboard that shows how many deals we close or how much stuff is being sold per second. We won't be able to use Apple Intelligence to put ourselves to sleep with really boring stuff about retaining clients, which seems to be about 110% of what everyone else is doing in the AI. All pedestrian stuff that means to help you compete with other businesses in the least creative ways possible. Apple Intelligence won't be able to figure out the 3% of your staff that you got to fire because of AI. But we will be able to imagine things and then have them appear, or not even imagine them. Let the iPhone imagine them for us. Let it personalize, using the knowledge you've given it for years, while at the same time not allowing anyone else to access it and bamboozle you. So once again, we're faced with the rapid instant analysis that this news from Apple is purely incremental. And once again, I think those same people will sheepishly upgrade their phones in a few months because they want Apple Intelligence and they want to make their own emojis like their friends sent. And they want to be able to use a touch-to-touch phone. Get rid of Venmo. See, you can imagine yourself, see yourself, learn about yourself all at the same time, and no one can steal your info. To me, that's a good deal. One that enhances your life and will eventually enhance the stock. Not today. It doesn't work like that. Bottom line, you want to call that incremental for Apple? Hey, I got it. How about this? How about this? It's revolutionarily incremental. Oh, no, I got it better. It's incrementally revolutionary. Or even better, Apple, own it. Don't trade it. Joe in Florida, Joe.
Jim, good afternoon. How are you?
Joe, I'm real good. I'm fighting mad about some other stuff, but I'm real good here. What's up?
Hey, I just want to start by saying that I am a proud club member, and your continued teachings and education are the best.
Oh, man, you're a good man. That Sunday piece I did yesterday, whoa. I mean, I read it like 7 times, but my editor even made it better. What's going on? What's going on? What's going on?
My stock's Boeing. Since it's low in April this year, the stock's climbed 12% to close today at 190. I have 2 questions. First question. One of the problems is that Boeing has reduced its build pace so much to address quality issues. It can't make enough planes a year, thus affecting its revenue. Boeing has a backlog of $529 billion in planes. How long, in your opinion, will the build slowdown go on for? Question number 2.
Yeah, go ahead. I'm sorry.
With the new executive management team coming on board in January and the quality control issues being addressed, is this a buy, hold, or sell? Thank you in advance.
Sure. Look, I think you can hold Boeing. I can't encourage people to buy. Now, here's why. Because it's not in Boeing's hands. It's in the government's hands. I got enough companies that have enough problems. But to have a company that's in the crosshairs of the government every single move, that makes it too difficult for me. So I'm going to have to pass on any recommendation. I need to go to Brian out in Oregon. Brian
in Wisconsin. How you doing, Jim?
I am doing well. What's up with you, partner?
Heck, we're doing well today. Quick one for you here. Given current economic conditions, everything, what's your outlook on Caesars Entertainment going forward?
Okay, Caesars is good, but I'm going to give you Wynn. My Chapel Trust owns Wynn. We talk about it a lot for the club. I cannot believe the stock's down at 92. It is doing so well, so much better than Caesars, but no one's focused on it. Craig Billings, will you please come on the darn show and talk to us about Wynn? All right, Apple Intelligence will let you imagine yourself, learn about yourself, and like Apple, what can I say? Not steal yourself? Or at least they won't try. It's a good deal. One that enhances your life and will eventually enhance the stock. Not today, not tomorrow, but you know how these things work. This was never meant to be a market mover. On Mad Money tonight, after the latest S&P 500 shakeup, I'm seeing if the removal of 3 names from the index should be an exit sign for investors, or is it an opportunity? Then I'm kicking off a new series on healthcare stocks by digging through the sector to find some pharma player that might be worth a closer exam. And Apple is only the latest company to announce AI-integrated computers. Let's talk with the CEO of HP to find out if its own slate of AI PCs is a growth signal. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
On Friday night, S&P Global booted 3 stocks from the S&P 500 and replaced them with 3 newcomers that better represent the current economy. They brought in CrowdStrike, the Cramer fave cybersecurity play. We had them on the show last week, along with KKR, the private equity pioneer, and GoDaddy, the website builder and digital marketing firm. That's why all 3 stocks jumped like they did today, because everybody knows the index funds will be forced to buy them when the change becomes official 2 weeks from now. No kidding. You know what? I want to do something different. I want to twist things around. I'm going to focus on the 3 stocks that got cut from the S&P 500. See if they're worth buying. Comerica, a suboptimal regional bank. Illumina, a DNA sequencing / diagnostics company. And Robert Half, a staffing and human resources consulting firm. I'm wondering what happens to these exiled companies aside from the initial wave before selling. Is there any hope for these companies, or are they basically doomed for the foreseeable future? If history's any guide, the answer is a little depressing. The answer is nothing good happens to them. All right, but I'm going to be scientific about this. Not going to be just seat of the pants. Let's take a look at the recent exposures for the S&P 500, because I want you to know how they performed. The last 2 stocks to get the boot were VF Corp, the troubled apparel play, and Dentsply Sirona, and that's a dental supplies company. And that happened early in April. So far, both stocks have continued to go lower since the initial announcement. VF Corp's fallen almost 13%, and Dentsply Sirona is off almost 19%. Meanwhile, the index they got kicked out of, it's rallied more than 2% over the same period. VF Corp's decline was actually worse than that for most of April and May, before the stock started showing signs of life in recent weeks. The company's reported yet another very bad quarter on May 22nd, and its stock has fell to a 52-week low of $11 the next day. But then it rebounded going into the close, and since then, it's acted a little better, climbing to $13 and change as bottom fishers started coming in. Betting the worst must be over. Look, anything's possible. I like Bracken Darrell, the new CEO, late of Logitech. This one is a tall order even for, say, Hercules. As for Dentsply Sirona, that one's been pretty much straight down since the news, including a 6% single-day decline after reporting a not-so-hot quarter in early May. Okay, let's go back further. On March 18th, Supermicro and Deckers Outdoor joined the S&P 500, and in order to make room for them, the index dumped Whirlpool, yes, Whirlpool, and Zions Bancorp, which is another troubled regional bank. When you look at their performance since the announcement on March 1st, these two are a mixed bag. Whirlpool's beset by lackluster home building environment and a consumer that's less willing to shell out for big-ticket items. So its stock has fallen more than 17%. But Zions Bank actually held up a little better. Stock's up more than 6.5% since the announcement, actually outperforming the 4.4% gain for the S&P 500 during the same period. But that's not anything really company-specific. See, it's just that Zions got hit insanely hard during last year's mini banking crisis, and the stock's gradually been recovering ever since we realized that a bank run was off the table. Sure, it's not doing great, but it's not doing terribly either. Certainly not to the point where we're worried it might go under. So, of the 4 stocks that have been dropped in the S&P 500 so far this year, 3 have underperformed significantly in all cases since the announcement, while just one, Zions Bancorp, has outperformed in the time since it got the pink slip. You know what? We also went back and looked at the 10 stocks that got kicked out of the S&P last year and still exist today, and you can see the same trends. Specifically, of those 10 stocks, only one has outperformed the index, and that's Lincoln National. It's a major insurance company, the Link, Philadelphia, where the Eagles play. Makes sense since they're in an insurance bull market, and we heard that from Chubb last week, right? The other 9 have lagged the S&P, some a lot more than others. For example, packaging company Sealed Air is up more than 13% since we learned about its dishonorable discharge last December. Not bad at all, right? But not as good as the S&P. It's up almost 17% gain over the same period. Hey, same deal with Organon. That's the drug company that's all about women's health and off-patent medicines. It's up nearly 20% since its dismissal from the S&P was announced last October. That's a fine performance, except the S&P's got a 24% gain over the same period. Of course, there were also some huge declines here. Of last year's 10 explosions, 5 are flat out down since we learned they were being removed, even as the S&P was up double digits versus every single one of them. Lumen Technologies, debt-laden communications company formerly known as CenturyLink, oh man, lost 60% of its value. Solar Edge, the struggling residential solar play, it's down more than 43% since we found out it was being excommunicated. Newell Brands, yeah, remember the old Newell Rubbermaid? Dropped 30% since the announcement. Wow, that's awful. And by the way, this analysis excludes the 4 other stocks that got kicked out of the S&P 500 last year. 3 of those were regional banks that got seized by the FDIC in order to prevent bank runs, while the 4th was Dish Network, which got acquired by EchoStar at the end of last year. But Dish Network stock was at $7.30 when we learned it was a goner. And when you look at the EchoStar shares you would have gotten in the takeover, well, they're only worth $6.26. So down 14% during a period when the S&P's up more than 25%. What a list we produced here. Now, why go through this whole exercise? Because when I saw the companies being expelled from the S&P last Friday night, Comerica, Illumina, Robert Half, my first thought was, hey, they're not that bad. Comerica's a decent enough regional bank, which happened to position itself poorly for the Fed's rapid rate hikes. But it'll be fine if rates come down later this year. Illumina had all sorts of trouble in the post-COVID era, but much of its management's been replaced over the past year. And last week, the stock jumped when we learned that they're spinning off their Grail cancer testing business later this month. Feels like it could be approaching a bottom. As for Robert Half, the staffing firm suffered from softer hiring trends in some of the most important end markets like tech. But it's still a company with a pretty good long-term track record. However, when you look at how these former S&P 500 components tend to perform, it's hard to get behind any of the new ones. Sure, removal from the S&P is not a death sentence, but the numbers here are stark, aren't they? Of the last 14 names that have been removed from the index and still exist today, dating back to the beginning of last year, only 2 have outperformed the S&P since the announcement. Bad odds. Don't forget, people talk about buying an index as passive investing, but the S&P 500 is more actively managed than people realize. The team at S&P Global does a fantastic job of deciding which stocks to add and which stocks to subtract. That's one of the reasons why I'm so comfortable with telling you to put a big slug of your savings in an index fund that mirrors the S&P. There's nothing passive about kicking out the weak and adding the strong. The bottom line, when you see a stock that gets expelled from the S&P 500, please don't bother to try to catch a bottom. You're most likely catching a falling knife. Historically, the odds are very much against you. If Standard & Poor's doesn't want them, well, you probably shouldn't want them either. Mad Money's back after the break.
Coming up, new healthcare names to consider. Cramer reveals a few healthier choices. Next.
As we get closer to the second half of the year, I think it's time to start thinking about what else can work in this market. Sure, the S&P 500 is up more than 12% for the year, but the vast bulk of that comes from tech. So what do I like for the second half? Well, look, I think it's clear that we're going to be getting a softer economy, even if that softness isn't spread very evenly, or is that even that evident right now? And the Fed's likely to leave interest rates a little bit higher than longer in order to be able to have, well, let's just say a slowdown. And what goes well in a slowdown? What do you need exposure to in industries that do just fine, even in a recession? Forget discretionary spending. We need necessity spending. You know what that brings me to? It brings me to healthcare, specifically the drug stocks. Over the past couple of years, the best stories in pharma have revolved around revolutionary GLP-1 diabetes and weight loss drugs. It's why I've been pounding the table on Eli Lilly for so long, and why we still own it for the charitable trust. But I can only extol the virtues of Lilly so much. Even with the big FDA advisory committee meeting on their Alzheimer's treatment, which took place today and was very positive. How about some drug stocks that haven't already had spectacular runs, but have been up? Every day this week, you know what we're going to do? We're going to run a series on my favorites, non-Eli Lilly pharma ideas, because I think that they can win in the second half of the year. I want you to be able to figure out which ones you like. Let's start with one that I'm really starting to, feel great about, and that's AstraZeneca. That's the British drug maker. Despite its nearly $250 billion market cap, I don't think AstraZeneca gets enough love. You just don't hear about this big pharma colossus all that much, do you? Even just focusing on European drug companies, it tends to get less coverage than, say, Novo Nordisk, the Danish company behind Ozempic, or even the big Swiss drug makers like Roche and Novartis. Never mind that AstraZeneca is slightly bigger than those two. But this company has a much stronger story than many people realize. For starters, AstraZeneca's got an amazing oncology franchise, among the best in the business. Remember we interviewed AstraZeneca CEO Sir Pascal Soriot last week because the company released 3 important data sets at the big American Society of Clinical Oncology Conference, also known as ASCO. They got a standing ovation for one of them. We're talking positive phase 3 data on 2 different lung cancer drugs and a breast cancer drug. These are breakthrough potential blockbusters. In fact, these guys when they got the data on this Tagrisso, that was the one they got the standing ovation for. This is a lung cancer treatment. So in a particularly serious, rapid onset form of lung cancer, this drug reduced risk of disease progression or death by an astounding 84% in patients with a specific type of non-small cell lung cancer. No wonder it got the standing O. That's an insane number, one that can save a lot of lives. This type of lung cancer affects roughly 15% of Americans who get the disease. And, well, for many, it's a death sentence, but maybe not now. By the way, we've had some updates on Tagrisso since the conference. Last Monday, AstraZeneca said they got a recommendation from a key committee in the European Medicines Agency. They say that this drug should be used along with chemotherapy in treating the type of lung cancer that the company's aiming for. Then just this morning, we learned that Tagrisso has been granted priority review by the FDA in terms of expanding its label to include this type of lung cancer. These are all great signs. As for the other 2 data sets for the American Society of Clinical Oncology Conference, we've got some extremely positive trial results from AstraZeneca's immunotherapy treatment for limited stage small cell lung cancer. As for the breast cancer drug data, it implies that this drug could offer an improvement in progression-free survival versus chemo. And that, again, is a very big deal. But frankly, these ASCO readouts are just the icing on the cake. The truth is, AstraZeneca has quietly been chugging steadily higher for years now, basically since the end of 2016, including a nice steady rise over the past 5 years. In fact, the stock's doubled in the last 5 years. Why has it done so well? Look, AstraZeneca never got a huge revenue boost from the pandemic. They developed a COVID vaccine with Oxford University, and they made an antibody treatment, but they weren't trying to make a lot of money off it. In retrospect, the lack of a COVID boom was a positive because after the pandemic subsided, there was no bust from lapping the difficult COVID-era comparisons. Contrast that, say, with Pfizer, which had it. Now, with AstraZeneca, it was much easier to just focus on the strength of the core business because there was never anything obscuring it. And hey, the core business is doing great. When AstraZeneca reported in late April, it delivered a blowout quarter, a monster revenue beat with a 15-cent earnings beat off a $1.91 basis. We reviewed the quarter ahead of our interview last week, and I was struck by how wide-ranging the strength was. All 4 of AstraZeneca's major segments grew by double digits and beat expectations. The only exception was the company's vaccine and immune therapies division, which is too small to matter right now. That was down 35%, but actually still well ahead of expectations. It's the one part of the portfolio that went through a post-COVID bust, but again, tiny relative to the rest of the business. That quarter was strong enough to kick off a big rally, even as AstraZeneca only reiterated its full-year forecast at the time. Since then, the stock's been able to continue running, in part because of the great oncological data I just mentioned, in part because they held an investor day on May 21st, where management laid out some incredibly bullish long-term targets. They're talking about doing $80 billion in sales by 2027, which is a stunning number, one that implies AstraZeneca can deliver an 8.5% compound annual growth rate. That's incredibly strong. As part of the path to $80 billion in sales, management said they believe they can have 25 multi-billion-dollar blockbuster medicines by 2030, nearly double the 13 the company has right now. 25. I know it sounds incredibly optimistic, better than almost every drug company, but given AstraZeneca's terrific track record over the past few years, I'm inclined to give them the benefit of the doubt. Last point here, at the moment, AstraZeneca is not a major player in the GLP-1 space, but they might be at some point in the not-too-distant future. Unlike many other big pharma outfits, these guys are not going for blanket, super powerful weight loss drugs. Instead, they have a more nuanced approach, recognizing that different subsets of overweight people have different goals. So AstraZeneca is working on 3 different molecules, all heading to phase 2 testing later this year. Each one is intended for different subsets of the overall obese patient population. As the GLP-1 market starts to mature, I bet they could see a lot of success with this kind of strategy, but it's not a near-term story. Let me give you the bottom line here of this very exciting situation. As we head into the second half of the year, I think you want some pharma in your portfolio to cushion the blow from a slowing economy, and you do a heck of a lot worse than AstraZeneca. Stay tuned for more new drug ideas through the rest of the week. Let's take calls. Let's go to Bob in Maryland. Bob.
Hi, Jim. I have a question about Procter & Gamble. I noticed that Walmart had a split recently, and they're doing very well, and they sell a lot of Procter & Gamble products. Procter & Gamble has been doing gangbusters lately. It was like 169 last week. It fell back a little bit now. What do you think Procter & Gamble's chances are in the near future.
Okay, I think it's a very interesting analysis you're doing about what's in Walmart and what does well, consumer branded products that Walmart sells a lot of. Actually, limit Procter & Gamble directly. It's going to be more of a function of the different products that they sell well everywhere, including at Costco or at Kroger. I think we own a big position for my charitable trust. It yields 2.5. We like the situation. Don't chase, but we do like Procter & Gamble. I need to go to Dave in Virginia, please, Dave.
Greetings from beautiful Virginia, Professor Cramer.
Oh, great to have you on the show. Thank you, Dave. What's up?
Hey, Bristol Myers is down about 30% over the last year and lower EPS expected for the remaining of the year, I think. But I noticed today on their public website they were recently granted FDA approval for a cell therapy treatment for non-Hodgkin lymphoma. Do you think it's time to invest in Bristol Myers?
I think that Bristol is going to be a long turn coming. And I think there are other pharma that are better. I do think, though, that it does seem to have reached some sort of bottom when it hit 5.75% yield. We're thinking about, but you have to go long term, maybe 20, 29, 30 before you get some really good news here. Okay, as we head into the second half of the year and possibly towards the slowing economy, I think it's worth owning some healthcare names like AstraZeneca. It's one that doesn't get enough love. I think you might want to consider it. Now, much more Mad Money, including my exclusive with HP. I'm talking with the CEO of the personal computing and device company. Find out where we stand on the AI PCs and more. Then what should you make of the new activist stake in Southwest Airlines? I'm mapping out the story to see if you should get on board with the stock. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. I keep talking about how we're on the verge of a brand new personal computer cycle as a whole new generation of machines with built-in AI will force people to upgrade. And you know who's leading the way here? HP Inc., the old Hewlett-Packard. Yes, its symbol is HPQ, just so you know. It unveiled its line of AI-powered PCs about 3 weeks ago. It then reported a great quarter a week and a half ago, one that sent the stock up 17% in a single session. So can this thing keep climbing? Let's check in with Enrique Lores. He's the president and CEO of HP Inc. Get a better read on the situation. Mr. Lores, welcome back to Mad Money.
Thank you, Jim. Good to be here.
Well, Enrique, you had quite a great quarter, and I'm beginning to believe, as you've been saying, we would get to an inflection point where you would see that the rate of decline slowed for 4 straight quarters, and then after that, we would begin to see PCs, with or without AI, we'll get to AI, really start to turn up. Are we at that point in the cycle?
Yes, Jim, we are pleased with the performance we had in the quarter. We grew operating profit, we grew EPS, but more important, we started to see growth of PCs again, driven by the momentum that we see in the commercial category, that, as you know, is the most important category in the PC space. And not only that, but also our services businesses grew, and we have very good momentum, and we start the second half of the year. So we're really pleased with the progress and the momentum we have now.
All right, well, let's talk about something that's going to supercharge the momentum. Let's talk about the AI PC, because maybe people don't realize. We spent a lot of time talking about what Apple's doing with its, obviously they're doing their AI, which they talked about today. But what you've got going is rather monumental. And I want you to describe to people what this new PC will be like and what it can do for us that your current ones can't.
Well, we are really excited about the creation of this new category, and there are 3 major things that people will be able to do. First of all, they will be able to experience what today they experience in the cloud locally. And this has 3 big advantages: cost, security, and speed. Second, and really very interesting as well, is PCs will personalize their performance. We are building models in the PCs that will learn how their users are using them. So basically, my PC will optimize for how I use it and will perform differently than your PC or the PC from someone else, which will help us to optimize performance and battery life. And third, especially for commercial customers, these PCs are going to be more secure than any other product before, because they also have built-in models that will learn from the new attacks and that will be able to prevent from attacks of viruses that have not been invited yet. So it's a great improvement in terms of security as well.
Oh, that's very good, because security is top of mind for many, many people. Let's talk about Copilot. What can an individual do with Copilot? We know corporations can use it, but how will we integrate it into our lives?
Just think about the key productivity things that anybody does, creating a spreadsheet, creating a document, doing an analysis. You will be able to do that with the local information. Let's say you have in your PC analysis you have done before, or you have all the emails that you have got. If you use one of the cloud applications, they don't have access to that information to provide you insights. Running the models in the PC, running Copilot in the PC, you can run all these things locally and get the same advantages that you have in terms of getting fast insights, just doing it locally. Again, faster, cheaper, and more secure.
Now, a lot of people are saying to me, Jim, you've emphasized that AMD is a good partner with HP, and that's true. But they're saying, listen, maybe you ought to focus a little more about how NVIDIA is a deep and trusted partner of yours, and that we NVIDIA in a lot of different HP machines.
Well, we are working with NVIDIA, we are working with Qualcomm, we are working with AMD. With NVIDIA, we have launched a new line of workstations and software to design language models. We call it AI Studio. We launched it with Jensen in March in our channel conference, and it really provides a much easier solution for data scientists to develop their own models, which we start to see also as a very big relevant business in the AI transformation that is happening. With Qualcomm and AMD, we are launching the new AI solutions. I was last week with both Cristiano and Lisa showing and displaying the new portfolio that is coming to market now or in the next week. So it's a very exciting time to be in technology and a lot of changes in our category.
Okay, now I know I talked with Best Buy last week. They've got a good relationship with you, and they're talking about the HP OmniBook X AI PC. You just mentioned it too. If I go at the end of the month, will I be able to find it?
You should be able to find it at the end of the month, and definitely it will be ready for the back-to-school season, which is really one of the most important selling seasons for Best Buy and in retail in the U.S. in general. And as you said, we have a very strong partnership with Best Buy. We have exclusive products for them, and we are excited about the opportunity this is creating for both companies.
Now, I don't want to lose sight of the fact that early on I've been following 3D printing. I refuse to give up on 3D printing because it's too economic. It makes too much sense. Where are we?
We actually, during the last 2 years, we have seen the 3D printing business and market impacted by the overall macro situation. We start to see some signs of recovery in the industrial space, and especially on the industrial side of print, we start to see some good recovery. We just had a major event in Germany during the last 2 weeks, and it was great to see the excitement and some of these categories are bringing again.
Okay, and then your future-ready plan, which is going to be, the whole time you've been remarkable with cash flow, but it sounds like there's even more to be gained because the cash flow here is extraordinary. You throw off a lot. Tell me about that plan.
Well, we are making progress executing that, and it has different elements. First of all, it's about continuing to build a stronger HP and building a more growth-oriented portfolio. And both with the investments we are doing in AI and also in our growth categories, we start seeing the momentum that this is going to be generating. We're also doing a lot of work to increase the effectiveness and efficiency of our operations, and this is what is translated in better profitability and higher cash flow. And we're also continue to invest in our people, because at the end, if we want to have a long-term sustainable company, we need to continue to invest in the teams. But we are pleased with the progress, and the strong financial results we delivered this quarter are a clear consequence of the progress we're making executing our plan.
Well, I think you're right. I think people were confused. How do you pay up above 17% on a single day? But I think the answer is this stock has got, you have a very inexpensive stock versus the future, which is very bright. I want to thank Enrique Lores, President and CEO of HP. Guys, the new PCs are coming, and it's going to be brought to you by HP. Thank you, Enrique.
Thank you, Jim. Great to be here.
Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. We're back for the same name. Secretary by just because of the call starter. My staff principal plan is out. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. We'll start with Kohl's in North Carolina. Kohl's. Coles, you're up.
Hello.
You're up, Coles. What's up? It's Jim.
Booyah, Jim.
Booyah.
This is Walter from North Carolina.
Okay.
This is the seventh time I've called in to talk to you, so this tells you how much I value your advice.
Oh, I appreciate that, sir. Thank you. How can I help?
Last week, I made a purchase of advanced micro devices.
Okay.
And the following day, it went up $6.18, been giving me a good profit. But the last 3 days, it has dropped. And a day, it should dropped over $7.50, giving me a huge loss.
Well, but let's remember, it's been a great stock over a long period of time since Lisa Su took over. I think it's just trying to settle. Got downgraded today. I thought the downgrade made some sense because the problem is NVIDIA is so powerful. But I'm not going to write off AMD. I'm not going to write off Lisa Su. She's too strong. I think you should hold on to that stock. Let's go to Melanie in South Carolina. Melanie.
Booyah, Cramer. I love your show.
Thank you.
Columbia, South Carolina, Gamecock Country.
Excellent.
I'm interested in the stock BWX Technology.
Yeah, it's another nuclear power play, and I totally get that people want those. That's why I keep sending people to GE Vernova, GEV, because they're nuclear, they're also natural gas, and they're also wind. And you want all of those. That's what we need to get out of this jam that we're in, and I say GE Vernova. Let's go to Paulette in Louisiana. Paulette.
Hi, Jim. Thank you for taking my call. This stock is supposed to split into 3 different companies. It's DuPont.
Yes, and I think DuPont must be bought. We've been buying here for the Chapel Trust. I've been emphatically telling club members DuPont must be bought below 80. It must be bought. Let's go to Tom in Rhode Island. Tom.
I bow to you, thy Cramer. I wish I listened to you 2 years ago. Instead, I got caught up listening to my kids' college professors pumping up these alternative energy ideas. They never amount to anything.
No, they don't.
They don't. Maybe this one is now cheap enough and in your wheelhouse, though, or is it just going to give me more bad gas? It's Bloom Energy, BE.
No, I don't want that. I'm going to say GE Vernova. I think Bloom Energy has been a very, very problematic stock for a lot of people, and I'm not going to say it's going to get any better. I think you can do a lot better than Bloom Energy, sir. They have not been able to make any money, and I think that's important for a stock. Let's go to Ruben in California, please. Ruben.
Hey, Jim. Sending you a friendly booyah from sunny California.
Oh, thank you, Ruben. I'll send you one right back from, Manhattan. Lower Manhattan. All right, fair enough. Lower Manhattan.
Thank you.
Bye,
shout out to Cassandra. Hey, with the holiday season approaching, what do you think of Shopify?
What holiday? Jeez, are we there already? Man, time is flying. Time is flying. Well, let me tell you, I think Shopify at 63 is just a good stock to own. It has been going down and down and down. It's kind of like, it's like a Springsteen song. I think this is the right level to buy. I really do. I think it's gone down, 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 and like right here, okay? Let's go to Hassan in Georgia. Hassan.
Mr. Cramer, what are your thoughts on Post Holdings?
It's an inexpensive stock. It's an inexpensive stock. I like inexpensive stocks. I think they're doing fine. I think it's a great call. I'm glad you brought it to our viewers' attention. John in Illinois. John.
Yeah, first-time caller. It's an honor, Jim.
I'm glad you're here. What's up?
Booyah and go Eagles.
Go Birds. What's going on? Illinois. I didn't know we had fly Illinois fly there. You bet. What's up?
Live Nation, LYV.
Live Nation. Okay, so Live Nation, yeah, look, the government's after them. That's never a good thing. And so I'm going to have to take a pass on this one right now. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's to-do list when an activist buys a stock. Southwest Airlines as a recent case study. Next.
When I see an activist investor take a major stake in a company, I do 3 things. First, I rate the work of the activist. Second, I consider the prospects of the target. And third, I try to gauge what are the chances of anything really happening that could bring out value. This morning we learned that Elliott Management, one of the smartest activist firms on earth, took a nearly $2 billion stake in Southwest Airlines, a once stellar performer that's lagged its peers rather dramatically in recent years. Elliott released a letter with a pretty thorough analysis of the decline and fall of Southwest, a company that once had a winning strategy. As Elliott puts it, Southwest, and I quote, revolutionized the airline industry with an innovative business model built on operational excellence and a commitment to providing customers with a low-cost alternative to the legacy airlines, end quote. But that was then. This is now. Quote, today, however, poor execution, leadership's stubborn unwillingness to evolve the company's strategy have led to deeply disappointing results, end quote. Elliott goes on to say, quote, Southwest's share price has declined by more than 50% in the past 3 years, end quote. In fact, until today's rebound in response to this announcement, the stock was trading at levels last seen during the depths of the COVID-related shutdowns. Elliott has worked on Southwest for 18 months, and they are, well, let's just say, quote, convinced that Southwest represents the most compelling airline turnaround opportunity in the last 2 decades, end quote. I like that. What can I say other than I couldn't agree more? It's stunning that an airline could deliver this level of underperformance during a travel boom. The lack of urgency from management seems somewhat odd given the circumstances. The people running this business seem downright oblivious. There's a litany of positive quotes from when CEO Bob Jordan came on CNBC, and the most damning one was after the first quarter of this year, a bad quarter. Listen to what he said. Quote, we had a strong first quarter despite the financial results. Oh, despite the financial results. Hey, it's that kind of like, other than that, Mrs. Lincoln, how was the play? Second question, what are the prospects for the company itself? I have to tell you that I think Southwest would be amazing if it embraces some of the big changes along with lines of what Elliott's proposing, but they can't get there on their own. In fact, Southwest has been going backwards with costs headed higher and opportunities missed thanks to a great deal of what Elliott calls, and I quote, I love this, uneconomic flying, end quote. The sky is literally the limit if Elliott can be brought in like a consultant, a serious consultant, a change agent, if you will. Yes, some heads might need to roll, figuratively speaking, maybe a lot of them, but these numbers just aren't good enough. To management's credit, they haven't played the blame game. It could have laid a lot of the blame at the feet of the hapless Boeing, which hasn't delivered the planes Southwest needed to operate effectively, let alone take advantage of the travel boom. But no matter who you blame, this company needs a major shakeup. Third, what are the chances of anything happening that could unlock value? Let's take a look at what the company said in response today. Quote, we maintain an open dialogue with our shareholders and value their perspectives related to enhancing shareholder value, end quote. Okay, open dialogue, good. The company says that they were just contacted by Elliott yesterday, and they, quote, look forward to better understanding the views on our company, end quote. Surprising there wasn't a little more contact, but it may be a sign that maybe there's no one Elliott thinks they can even work with all that constructively there. Maybe a thorough house cleaning's needed. At the same time, Southwest felt compelled to tell us, quote, the board of directors is confident in our CEO and management's ability to execute against the company's strategic plan to drive long-term value for all shareholders, end quote. Now, if you want to translate that Wall Street gibberish into English, it sounds like something like, we're committed to the status quo. Unfortunately, the status quo is just not good enough. I don't think anyone but the board of directors is satisfied. The fact that the board seems sanguine about both the plan and this team's ability to execute it, that seems both smug and gratuitous. Maybe the board needs a total shakeup if they're satisfied with this level of underperformance. That said, my judgment, the stock's too cheap. Southwest board is misjudging the shareholder loyalty here. It's to better financial performance, not to the board of directors or the CEO. I believe Elliott can start making things happen. To me, that says you should buy the stock because going forward, the status quo will no longer be accepted by the actual owners of the company, and that's the shareholders. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.